Right, as a follow-up to my last video regarding Tiff's strategy change that he announced on Thursday in Calgary, I want to do a deeper dive into what it likely means for the Canadian economy and what impact that could have on interest rates and mortgage rates. So, if the Bank of Canada is going to be more data dependent and reactive as opposed to being proactive, they are going to wait longer for confirmation that inflation data is moving lower, even in the face of a bad recession. They are not going to be proactive like they normally would and see very weak economic data and forecast out that eventually that means lower inflation because of a weak economy. They're not going to do that. They're actually going to wait until the inflation data shows that it's coming down. So this leg, which is normally 6 to 12 months, is probably going to get doubled. Okay, so that means that the Bank of Canada is going to be slower to react, which means the economy is going to have more time to manifest into a deeper, longer recession than it normally would be when the Bank of Canada is being proactive. Okay, so that's probably what's going to happen here. Because the Bank of Canada is unsure and uncertain of its forecasting abilities right now because of all the uncertainty in the world, especially with regards to trade, they are going to be reactive as opposed to being proactive. So what does this mean for interest rates and mortgage rates? Well, if the Bank of Canada is going to be slow to react and the economy is tumbling badly, the bond rates are going to assume that inflation further out the curve is going to come down and come down hard. So fixed rates are going to stay where they are or go lower, because the market is going to assume that there's going to be little chance of long-term inflation because the economy is going to tank so hard. So this is going to weigh on fixed rates. Variable rates, they were likely to come down this spring, but I believe that the Bank of Canada is now going to take a pause in April. How long that pause is going to last for will be dependent on what the federal government does to support industries that are hardly hit by these tariffs, and obviously what that means for inflation. For example, if the federal government starts spending billions and billions of dollars to support certain industries, that could be inflationary. If it is inflationary, then the Bank of Canada is not going to be able to bring down variable rates in the near future, and they might even have to hike. I think that is a very low probable event, them hiking, but it's not a non-zero event anymore. Okay, so that's what's probably going to happen with variable, but eventually when inflation is under control and starting to trend lower, the Bank of Canada will bring variable rates down, and they'll probably bring them down aggressively and quick. So it's just kind of the timeline's being moved out a bit, I guess you could say, as opposed to in the next 6 months of rates coming down, variable rates, to maybe like 6 to 12 months out. So in the second half of this year. And they'll probably come down harder and faster because of the Bank of Canada being reactive as opposed to being proactive. So that's really what all this means. It just means we're going to end up with a deeper, longer recession because of the uncertainty and the inability of the bank to be proactive. And it also means that variable rates are probably not likely to move substantially lower until later this year. Have a great day, everyone.